Welcome to Ben's Market Insights. Another busy week of activity on markets. So we're going to talk about blockading the blockade. What's that all about? We're going to be looking at the implication of the oil price on long-term inflation. And we're also going to be looking at the banking results coming up this week and what they could be telling us, as well as an update to our asset allocation strategy. So jumping in, we had a brilliant interview last week with Anthony Scaramucci, and he posited the idea that the US really needs to negotiate with China as the paymasters of Iran effectively. China buys 90% of its oil through, or gets 90% of its oil from Iran through the Straits of Hormuz. And as such, for me, and certainly when Anthony put it to us that this agreement needs to be in place with China, it makes total sense, therefore, this blockade of the blockade, because what the Americans are essentially trying to do here is to stop the Iranians from being able to export any oil at all through the Straits of Hormuz, and that would then put pressure on China to start those negotiations. We've said this before, China has some 140 days of reserves, so it's in a fairly decent position in terms of its ability to continue growing the economy. Energy in all its forms through transportation and use of in homes, etc., does account for some 15% of the CPI basket in China. It's still a little bit higher than that you'd expect in developed markets. It could and does get some of its oil from Russia, but its refineries are much more calibrated towards the lighter Iranian crude, so there would have to be some infrastructure changes going on, and I suspect that's certainly in their long-term planning. It is worth pointing out that a 10% increase in oil price consistently over a period does lead to a 0.5% impact on PPI in China. It's interesting that they have started to move. Certainly, we've seen that in terms of their energy infrastructure, a lot more move towards nuclear usage and away from oil usage. And we've seen also electric cars and hybrids are now some 50% of new sales in China. And the combination of those two account for some 12% of the current fleet of some 300 million drivers. But however, some 300 million drivers still need gasoline at the pumps. So still a major factor for China. Pre-war, we had seen consensus estimates certainly of some 4.6% growth in GDP and a 1% inflation this year and next. I suspect both of those are going to have to be revised, one lower, the other higher. We know which ones that's going to look like. And that Q1 GDP of 4.8% potential, which would be higher than the 4.5% in Q4, is probably in the bag, but certainly going to Q2 and Q3 might see some impact on that as more of the economy looks to save on their energy usage and potentially reduce some productivity in the process. In a long term, this can still lead to some de-dollarization as Russia and China start to kind of work outside of the SWIFT system of clearing accounts, and that is not good from a US perspective. I think Russia will play a big role in that supply of oil to China. But nonetheless, I totally see the logic of blockading the blockade in order to drive China to the negotiating table with Iran. If you're enjoying this content, please jump onto our subscription and give us a like. That would be hugely appreciated. Thank you. So that's kind of from my perspective what's going on that front. And thanks to Anthony for that perspective. Let's kind of look at the US economy a little bit. US CPI for March is likely at 3.3% or higher. That is driving inflation back up again. We're unlikely to see that fall in the near term. The economy, however, still appears to be relatively robust. We saw some 180,000 jobs added in March versus a contraction in February. but I wonder if that was weather related. And so we're back to more normality than anything else. PPI comes out today, Tuesday. It's likely to reinforce the message from the CPI and is a precursor, if you like, to further inflation and CPI numbers down the line as PPI feeds into CPI. And that is the whole oil trade in logistics and infrastructure, and is going to certainly, if we don't see any kind of resolution, which again, Anthony's perspective from last week would suggest we're likely to have months worth of continuous disturbance in markets as a result of this war, that this inflation is not transitory but quite permanent, certainly semi-permanent to some extent over the next few months. We've had some retail figures out of Europe. Certainly consumer remains in the doldrums. Euro inflation should be heading higher, again because of this energy infusion. As well, European Central Bank does not have an opportunity to reduce rates any further, but certainly may even start to think about hiking, given those inflationary fears. And so once again, it is not a great place to be in terms of the investment environment in Europe. On a micro basis, we've got the banking sector releasing their results this week. The ETF, the specific banking sector ETF, has performed incredibly badly, certainly since 2023, down some 10% year to date. We had Goldman Sachs yesterday. We've got JP Wells, Bank of America, Citi, and Morgan Stanley reporting this week. I suspect, and certainly confirmed by Goldman Sachs yesterday, the investment banking fees are doing well and should continue to be strong. Certainly a lot of M&A activity and potential IPO upside, but the geopolitical environment again here may slow those activities down. It's the most sensitive part of the capital markets, and so we may well see some reduction in those corporate finance type fee generation. Having said that, what we continue to believe is there is a steepening in the yield curve. The central bank is in control of the short end, but is not in control of the long end. So continuous steepening is likely to happen going forward, although it's been relatively flat over the last 2 or 3 weeks. That should be good for net interest margins and therefore bank profitability. Having said that, can't see management really putting their necks out to give a positive guidance, and certainly I suspect they're going to be talking about caution, and we'd expect Jamie Dimon at JP certainly to be much more cautious than most of the management of the different banks. The sector is still not particularly cheap on a historic basis, so I wouldn't be punching the lights out to jump into the sector. But nonetheless, this potential for steepening yield curve is going to be positive for profitability going forward. Looking at asset allocation implications, we were overweight going into the US. That has hurt at the beginning of the year. Still see the US as the top dog in terms of the potential upside to markets going forward. Still believe that the tech trade that's now on much more reasonable valuation footing has pricing power and is a major contributor to that economic productivity gains, which I think the US will have over any other nation going forward for quite some time. And so the AI spend is increasingly releasing efficiency, higher efficiency and optimization. And if that's happening in a slowing economy, then the tech trade remains, I think, strangely enough, a defensive trade. UK, Europe and Asia are going to be held back by inflation and growth, and there's really no room for lowering interest rates any further. The US has the opportunity to reduce interest rates somewhat from this point in time, and I maintain that once Kevin Walsh comes in, he is certainly unlikely to raise interest rates, but more likely to reduce. But that's going to be pushed out somewhat. Felt it could happen in May. We're now looking probably around June, July. And so the overexposure to the US remains in place versus the benchmarks. Tech remains an overweight versus the benchmarks. That is, I think, likely to start to show some benefit going into the second half. And a weak dollar is likely to continue and remain as the central feature of what we're seeing going into the second half, particularly as European and UK interest rates are not going to fall. Japan is likely to rise, and the US is probably the only one with room for interest rates to decline, which leads to this weakening in the dollar. Remain equal weight as far as what is an expensive energy sector, and that's almost a hedge based on this elongated process, again, as Anthony had mentioned last week, in terms of the oil price shock that we're seeing and the likely continued longer term or longer duration of this war, which we're probably going to witness for some time to come yet. Anyway, I'll leave it there. Thank you for your time and speak very soon.